Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Electronic Arts, the publisher behind FIFA, Madden, Apex Legends, and The Sims, and the company that built gaming's most durable live service machine.
Electronic Arts was founded in 1982 by Trip Hawkins in San Mateo, California. Hawkins had a controversial but prescient vision: treat game designers as artists and put their names on the packaging, like record album credits.
EA's early identity was built on sports games. John Madden Football launched in 1989 and began one of the longest-running annualized game franchise relationships in the industry, tied to an exclusive NFL license.
FIFA Soccer launched in 1993, establishing EA's global sports simulation dominance. For 30 years, the FIFA franchise was EA's most valuable property, until the two parties separated and EA rebranded it EA Sports FC in 2023.
Andrew Wilson became CEO in 2013, succeeding John Riccitiello. Wilson's strategic pivot was decisive: shift from single-purchase box games toward live services, ongoing in-game purchases, downloadable content, and subscriptions.
Today, roughly 75% of EA's net revenue comes from live services. The largest contributors are Ultimate Team, the card-collecting mode inside EA Sports FC and Madden, and Apex Legends, the free-to-play battle royale.
The live service model creates powerful retention. Players who invest hundreds of hours building Ultimate Team squads or leveling Apex accounts face enormous switching costs. That player investment compounds year over year.
Apex Legends launched in 2019 and reached 25 million players in its first week, the fastest launch in EA's history. It remains one of the most played battle royales globally.
EA's exclusive simulation licenses are a structural moat. The NFL, NHL, and college football licenses prohibit competitors from building equivalent official team simulation games. EA Sports FC retains league and club partnerships globally.
Gross margin runs around 75%, reflecting EA's heavily digital revenue mix. The EA app, EA's PC distribution platform, and EA Play subscription add recurring revenue with lower per-unit delivery cost.
EA employs roughly 9,800 people across studios globally. The portfolio spans sports simulation, first-person shooters, life simulation, and narrative role-playing games.
Andrew Wilson has held the CEO role for over a decade. He started at EA in 2000, building the sports marketing division, eventually leading EA Sports before the board chose him to restructure the company around digital revenue.
EA's relationship with gaming communities is famously complicated. Loot boxes, microtransaction systems, and annual sports franchise releases have generated sustained criticism, a known factor in the community trust metrics.
The competitive radar shows EA's sports license moat and live service revenue ranking highest among major publishers, while community trust scores reflect the ongoing tension between monetization design and player satisfaction.
EA Play subscribers get access to the full catalog plus early trials. The subscription layer keeps players inside EA's ecosystem rather than cycling to competitors' storefronts.
EA's studio network spans Redwood City, Vancouver, Stockholm, and Bucharest, producing sports sims, shooters, and narrative games from a geographically distributed creative base.
That's the Electronic Arts chapter: 4 decades of franchises, a live service transformation, and a catalog spanning every major gaming genre. The model has permanently shifted toward recurring revenue.
Exclusive licenses, live services, 600 million active accounts, EA built a durable, recurring revenue engine. Let's get into the numbers.
Electronic Arts is being taken private in a $55 billion leveraged buyout by Saudi Arabia's public investment fund, Silver Lake, and Affinity Partners, the largest acquisition in gaming history. Shareholders received $210 per share in cash. Against that backdrop, Q4 FY2026 posted a double miss. Non-GAAP EPS of $1.59 missed $2.49 by 36%. The deal dominates everything. This is Charged Alpha. I'm Hudson.
And I'm Lana. Electronic Arts is one of the world's largest video game publishers, with a portfolio spanning annual sports franchises, EA Sports FC, Madden NFL, and college football, live service multiplayer titles like Apex Legends, and The Sims franchise. Approximately 75% of revenue comes from live services, in-game purchases, subscriptions, and downloadable content. Gross margin runs approximately 73%. Market cap pre-deal was $50 billion.
CEO Andrew Wilson has led EA since 2013, pivoting the company toward digital and live service revenue streams. EA's sports licensing portfolio, exclusive simulation rights to the NFL, NHL, and college football, plus EA Sports FC league partnerships globally, creates competitive barriers rivals cannot replicate. 600 million monthly active accounts and 10 million EA Play subscribers reflect the scale of EA's live player communities.
Q4 FY2026 revenue of $1.86 billion missed the $2.06 billion estimate by 9.4%. Non-GAAP EPS of $1.59 missed the $2.49 consensus by 36.1%, a double miss in the final quarter before going private. The shortfall was driven by game launch timing variability and weaker-than-expected full-game sales volume during the quarter.
The full-year FY 2026 net bookings of $8.026 billion tell a different story than Q4 alone. Bookings growth of 9% year-over-year is a record for EA, and bookings capture the underlying player spending activity, including deferred revenue items. The disconnect between strong full-year bookings and the Q4 EPS miss reflects recognition timing in EA's accounting model, not a demand collapse.
Free cash flow on a trailing basis was $1.77 billion. Strong fundamentals for a $50 billion company heading into an LBO. The balance sheet shows approximately $2.8 billion in cash against $1.9 billion in total debt, a net cash position near $800 million. That clean balance sheet is part of what made EA an attractive private equity target for Silver Lake and PIF.
Gross margin of approximately 73% reflects EA's digital-first model. The shift from physical discs to digital downloads and live service revenue has progressively eliminated distribution costs. That margin profile, combined with the recurring live services revenue, is the financial architecture that supports the $55 billion acquisition valuation.
The LBO is valued at $55 billion. PIF provides the sovereign wealth capital from Saudi Arabia's investment arm. Silver Lake is the primary private equity sponsor. Affinity Partners, co-founded by Jared Kushner, is a co-investor. EA shareholders receive $210 per share in cash, a 40 to 50% premium over pre-announcement prices. This is the largest leveraged buyout in gaming history.
UK and China regulatory approvals have cleared the transaction. CFI US Review, the Committee on Foreign Investment in the United States, is the remaining regulatory step given PIF's Saudi government affiliation. The deal is expected to close in June 2026. Post-close, EA becomes private, ending decades of quarterly public reporting and transferring capital allocation to the new ownership group.
Analyst reaction to EA earnings is unusual because the LBO transforms the analytical framework. With shareholders receiving $210 in cash, analyst price targets have converged near the deal price. The fundamental question shifted from EA's standalone value to deal completion probability, whether CFI US clears PIF's involvement or imposes conditions that alter the transaction structure.
Before the LBO announcement, analyst consensus on EA was mixed at best. The company had missed estimates in multiple quarters driven by game launch timing. The constructive view required believing the live service flywheel, Ultimate Team in FC and Madden, Apex Legends, The Sims, would sustain bookings growth. Record FY 2026 bookings of $8 billion validated that thesis even as individual quarters disappointed.
The Q4 earnings miss generates less concern than it would for a standalone company. Analysts who previously rated EA hold or neutral are maintaining those ratings through deal close rather than revising on fundamentals. The binary question is now, does the transaction close at $210, or does a regulatory issue create downside below the current stock price near $200?
PIF's involvement elevates regulatory attention. Saudi Arabia's sovereign wealth fund investing $55 billion in an American gaming and entertainment company is receiving bipartisan scrutiny in Congress. CFI US Review, which evaluates national security implications of foreign investment, is the approval step analysts are tracking as the most binary risk in the transaction timeline.
The going private structure removes EA from public market scrutiny, which carries implications for the broader gaming sector. Analysts who have covered EA's franchise monetization, community trust issues, and live service practices will lose that visibility post-close. For the public gaming market, EA's exit removes a key data point on sports simulation economics and live service monetization trends.
The bull case is straightforward. The deal closes at $210. That represents a 40 to 50% premium over pre-announcement prices. Record FY 2026 bookings of $8 billion and $1.8 billion in free cash flow validated the asset quality that attracted PIF and Silver Lake. No fundamental turnaround is needed, only regulatory clearance and deal execution.
EA's underlying franchise moat supports the standalone case if the LBO fails. Exclusive NFL, NHL, and college football simulation licenses are structural barriers rivals cannot replicate quickly. The Ultimate Team live service flywheel creates switching costs that grow automatically each year. A standalone EA on a record bookings trajectory would force meaningful re-ratings from analysts who previously rated it a hold.
PIF's sovereign wealth investment horizon is a strategic advantage over public market quarterly pressure. Gaming titles take 3 to 4 years to build. A patient private owner can absorb development timelines that public investors chronically discount, potentially unlocking the full value of a franchise portfolio that includes some of the most valuable sports simulations in the world.
The bear case begins with deal risk. UK and China have cleared the transaction, but CFI-US review of $55 billion investment in an American company is the binary event. A block or conditional approval requiring PIF to reduce ownership below a control threshold would alter the deal structure materially and likely reduce per-share proceeds from the announced $210.
Post-close leverage is the structural risk inside the deal. The LBO will add approximately $20 billion in new debt to EA's balance sheet. Gaming revenue is cyclical. A weak title launch year, a competitor gaining live service share, or a player spending downturn could stress debt service capacity. The clean balance sheet that made EA attractive becomes significantly encumbered post-close.
The Q4 fundamental miss matters beyond the LBO context. Non-GAAP EPS missing by 36% is a meaningful variance, not a rounding error. Game launch timing risk and full game sales softness are structural dynamics in the entertainment business that private ownership does not eliminate. These risks persist in LBO regardless of ownership structure.
EA's community trust deficit is the long-term brand risk. The chapter data shows EA scoring lowest on community trust among gaming peers, a reflection of aggressive microtransaction monetization, quality concerns on annual franchises, and high-profile service failures. Private ownership removes quarterly investor accountability for these practices, potentially intensifying the brand erosion risk.
Take-Two Interactive is the most direct peer. Take-Two's Grand Theft Auto VI is the single most anticipated gaming title in history. Its release window creates a near-term catalyst that EA's portfolio cannot match. Take-Two builds revenue around tentpole blockbusters versus EA's annual sports franchise cadence. That different risk profile commands a higher speculative multiple from investors pricing in GTA V6.
Activision Blizzard, now inside Microsoft, provides the roadmap for what gaming consolidation at this scale looks like post-close. Microsoft's Activision acquisition created regulatory precedent that the EA PIF deal team has studied. Post-integration, the Microsoft gaming segment demonstrates that large gaming portfolios can operate inside major conglomerates.
Ubisoft is the negative case study. Despite owning valuable franchises, Assassin's Creed, Far Cry, Rainbow Six, Ubisoft has struggled to generate M&A interest at its market value and has faced multiple failed privatization discussions. The contrast with EA highlights how sports licensing exclusivity and live service scale command a structural valuation premium that IP portfolios without locked sports licenses cannot achieve.
Pre-announcement, EA traded at roughly 7 times trailing price to sales, a premium over Activision's pre-MSFT multiple of 3 times, reflecting EA's recurring live service revenue profile. Take-Two trades at elevated multiples driven by GTA 6 optionality. The $55 billion deal valuation implies roughly 7 times trailing revenue, in line with where public markets had priced EA's assets.
EA options activity collapsed into a merger arbitrage structure after the LBO announcement. Pre-announcement, EA showed typical gaming sector implied volatility tied to earnings cycles and launch windows. Post-announcement, the option surface repriced sharply lower as the stock locked toward the 210 deal price, with residual volatility reflecting CFIUS risk timing and the probability distribution around deal closing date.
Post-earnings options movement was muted given the deal floor. A 36% EPS miss would normally trigger aggressive put buying and downside hedging. In EA's case, the 210 acquisition floor suppressed the magnitude of options-driven selling post-print. Traders positioned around the earnings miss found their downside limited by the deal structure. The stock moved modestly, not dramatically.
CEO Andrew Wilson and the EA management team received material payouts under standard change of control provisions. Accelerated vesting of equity awards and deal completion bonuses align executive incentives entirely with closing the transaction rather than standalone performance. Wilson has been CEO since 2013 and his equity exposure is substantial. No insider sales have occurred that signal deal concerns from the management side.
The combined read from options and insider data points toward deal completion confidence. Options pricing reflects merger arbitrage spread compression, not fundamental concern. Management incentives are aligned with close. The only signal that would change this picture is a regulatory development, specifically CFIUS action, that reopens EA as a standalone company trading on its underlying gaming fundamentals.
EA posted a double miss in Q4 FY2026, but produced record full-year bookings of $8 billion. The company is exiting public markets at a $55 billion premium valuation, $2.10 per share in cash.
The risk is entirely in the deal close. CFIUS review of PIF's involvement is the binary event. If it clears, EA goes private at a historic premium. If it doesn't, EA retrades on gaming fundamentals with strong bookings as the foundation.
Financial data and charts, sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.